All right, let's jump straight into it. That time of year, tax season, right? And specifically, that moment you're staring at those forms, the ones about your retirement and investment payout.
Oh, yeah. That stack of paper.
It can honestly feel like you're trying to decode some kind of alien message sometimes, you know?
It absolutely can. They're dense, filled with boxes, numbers, codes. It feels designed to give you a headache.
Right.
But they are, I mean, fundamentally important. They're really the key to understanding what happened with your money that year and, crucially, how it affects your tax bill.
Exactly. And that's precisely why we're here today. We're doing a deep dive, a mission, if you will, to sort of demystify two really crucial documents. You've probably seen them. Form 1099-9R.
That's the big one for distributions.
Yeah, distributions from pensions, annuities, retirement or profit-sharing plans, IRAs, insurance contracts, etc. Long title.
They love their long titles at the IRS.
And its partner, Form 5498, which is IRA contribution information.
Right, the flip side, what went in.
So our goal for you listening is simple. We want to arm you with the knowledge to not just, read these forms box by box, but to actually spot the tax-saving opportunities.
And avoid the pitfalls. They're definitely pitfalls.
Definitely. Navigate it all with confidence. Think of it like getting an edge in your financial planning.
Yeah, and we're basically pulling back the curtain on the official stuff, the IRS instructions, the forms themselves. We're not just skimming the surface.
Really?
We want to highlight the critical details, the things people often miss, the nuances that can actually make a big difference to your bottom line. These aren't just compliance docs. They're kind of a roadmap if you know how to read them.
Okay, let's do it. Let's unpack this. Starting with Form 1099-R. So Form 1099-R. So at its heart, what's it telling us? Why is it such a big piece of this whole tax puzzle?
Okay, so 1099-R is your official statement for distributions. It reports money paid out from a whole range of sources. Think pension, annuities, your 401ks, 403bs, even governmental 457b plans, IRAs, of course, and certain insurance contracts, too.
Wow. Okay. So basically, any retirement-ish account payout.
Pretty much. And its main job is twofold. First, it tells you, the person getting the money, and it tells the IRS exactly how much you received.
Okay.
And second, this is the really key part, it specifies how much of that money is considered taxable income. It's the IRS's way of tracking money leaving those tax-advantaged accounts.
Got it. The official record of money out. What about the top part? The basics, names, addresses, tax ID numbers. Anything tricky there?
Not usually. The top section is pretty standard stuff. Payer's info, your info name, address, taxpayer ID number, your TIN.
Right.
One thing, though, for security, your copy might only show the last 4 digits of your TIN. Don't worry about that.
Okay.
The full number goes to the IRS. The account number is just the payer's internal reference for your account. Can be useful if you have, say, multiple IRAs at the same bank.
Yeah.
Helps you track which one this form is for.
It's simple enough. Okay, now the really interesting part. The boxes. The numbers that actually, determine your tax situation. Let's start with box 1, gross distribution. Sounds like the main number.
It absolutely is the headline number, yeah.
Yeah.
Box 1 shows the total amount distributed to you for the whole year. And this is before anything was taken out, before taxes were withheld, before any deductions.
The total outflow.
Exactly. And it covers a lot. Direct rollovers are in there, Roth IRA conversions, recharacterized contributions, your regular pension payments, one-off withdrawals, even if you completely emptied the account.
Okay.
It even includes things like withdrawals from certain automatic contribution plans, or if they had to correct an excess contribution you made, it's the grand total.
Right. But you hinted earlier, just because it's in box 1 doesn't mean you pay tax on all of it. That sounds like, well, a potential tax saver right there.
Precisely. And this is where you need to pay attention. It's a huge potential tax saving point for you. Box 1 is the gross, yes, but it's not always all taxable immediately. Well, for example, maybe you did a tax-free transfer of a life insurance contract. Or maybe charges were taken from an annuity to pay for qualified long-term care insurance.
Okay.
Those amounts are in box 1, but they're usually marked with a specific code in box 7, like code 6 or code W, which we'll definitely get into later. And the key is those amounts are generally not reported as income on your tax return.
Ah, so box 1 includes it, but another part of the form, or the rules, says ignore this for tax purposes.
Essentially, yes, it's an immediate tax deferral or exclusion, keeps money in your pocket, tax-wise, for now.
Okay, that's good to know. So if box 1 is the gross, then box 2A, taxable amount, That's what real action is tax-wise.
Yeah.
What's the absolute critical thing listeners need to know about this box?
Box 2A is, generally speaking, the part of your distribution that's subject to federal income tax. Now, the crucial insight for you is this. If Box 2A is blank,
Blank.
yeah, blank, or if the little checkbox in Box 2B labeled taxable amount not determined is checked, then you, the taxpayer, are responsible for figuring out the taxable amount.
Whoa, okay. So the bank or broker doesn't always figure it out.
Very often not, especially with traditional IRAs.
Why is that?
Because the payer, the financial institution, often doesn't know your full history with that IRA. Specifically, they don't know your basis,
Basis meaning.
meaning any contributions you made with after-tax money over the years. They don't know how much of that withdrawal is just getting your own already taxed money back, so they can't calculate the taxable portion accurately.
So the responsibility lands squarely on us. That feels like a spot where people could easily make a mistake if they aren't careful.
It's a huge potential pitfall. You absolutely have to track your basis if you've made non-deductible contributions.
But you also said Box 2A can show tax savings. Like if it's zero, when does that happen?
Right. Seeing a zero in Box 2A is usually a very good sign. It means a tax deferral or tax-free event happened. This is a direct tax-saving opportunity. It happens in a few key situations,
Okay, like what?
like direct rollovers. If you move money directly from, say, your old 401k to a traditional IRA, Box 2A should be zero. The money stays tax-deferred.
Makes sense. Moving it, not taking it.
Exactly. Unless, slight caveat, you roll non-Roth money into a Roth account, that's a conversion, and it is taxable.
Okay, what else gives you a zero in 2A?
IRA recharacterizations. If you change a contribution from traditional to Roth, or vice versa, the movement itself isn't taxed. Also, Section 135 exchanges tax-free swaps of insurance or annuity contracts,
All right.
those non-taxable charges for long-term care insurance we mentioned, and also a direct payment from a traditional IRA to an employer plan that accepts it. All those keep the money from being taxed now.
That's a good list of good news scenarios. Now, what if it's not zero or if it's blank and we have to figure it out? You mentioned annuities earlier. Is there a special way to calculate the tax on those?
Yeah, for annuity payments from qualified plans, especially if they started after 1997, you might need to use what the IRS calls the simplified method. Section 72D1 is the official reference.
Simplified method. Sounds okay.
It's an IRS formula. It helps you figure out how much of each payment is tax-free return of your original investment, your basis, based on how much you put in and how long the payments are expected to last.
So it spreads out that tax-free recovery over time.
Exactly. It ensures you're not taxed again on your after-tax contributions. You got to calculate it right to recover your basis accurately.
Okay. That brings us neatly to Box 2B. Two checkboxes here. Taxable amount not determined and total distribution. Let's take the first one.
Right. Taxable amount not determined. We basically covered this. If that box is checked, the payer couldn't figure out the taxable amount, usually because they don't know your basis. Common for traditional IRAs.
And it means?
It means Box 2A should probably be blank, and the responsibility is on you to calculate the taxable part. It's a heads up. Your turn to do the math.
Got it. And the second checkbox, total distribution.
That one's simpler. It just means the payment in Box 1 was the entire remaining balance in your account for that year. The account is now empty, closed out.
Why does that matter?
It's important because a total distribution can sometimes qualify you for special tax treatments, like that 10-year tax option using Form 4972. But again, that's mostly for people born before January 2, 1936. It signals the end of that specific account's life.
Okay. And speaking of special treatment, Box 3, capital gain, included in Box 2A. This also connects to those older rules, right? How can this save tax?
It certainly can for that specific group. If you got a lump sum distribution from a qualified plan and you meet the birth date requirement, born before Jan 2, 1936, the amount in Box 3 might be eligible for that special 10-year averaging on Form 4972.
Instead of regular income tax rate.
Exactly. Instead of being taxed as ordinary income at potentially higher rates, this method often results in a lower tax. Also, for charitable gift annuities, Box 3 amounts are treated as long-term capital gains, which usually have preferential tax rates.
Good to know if that applies. Okay, Box 4, federal income tax withheld. Seems simple, but you mentioned actionable advice here.
Yeah, it's straightforward. It's the federal income tax already taken out. You report this on your return, and it reduces what you owe or increases your refund.
Standard.
But the actionable part is control. For most distributions that aren't eligible for rollover, you can actually tell the payer how much tax to withhold or even choose not to have any withheld.
Really? How?
You use Form W4P for periodic payments like pensions, or Form W4R for non-periodic ones like most IRA withdrawals. This gives you control over your cash flow during the year.
So you're not stuck with their default withholding.
Right. Periodic payments are often treated like wages for withholding, using W-4P settings. Non-periodic ones, especially from IRAs, often have a default 10% withholding, using W-4R, but you can change that. You can adjust it based on your overall tax picture.
That's really useful flexibility. Okay, box 5. Employee contributions, designated Roth contributions, or insurance premiums. You said this is about basis, a core tax-saving idea. Unpack that for us.
Absolutely foundational. This is one of the most crucial boxes for saving tax, and honestly one people often overlook. Box 5 shows your investment in the contract, your basis.
Which is?
It's the money you put in using after-tax dollars, or it's your contributions to a designated Roth account within a plan. The critical point is this amount comes back to you tax-free.
Because you already paid tax on it once.
Precisely. You paid tax when you earned it and contributed it. Box 5 is the record that prevents you from being taxed on that same money again when you withdraw it. It directly reduces the taxable amount of your distribution shown in Box 2A.
So tracking this is vital.
Absolutely vital. If you have after-tax money in a traditional IRA or basis in a Roth 401k, Box 5 is your proof. It also includes the non-taxable part of charitable gift annuities or recovered premiums on commercial annuities. Don't pay tax twice.
Okay, message received. Track your basis. Now, box 6, net unrealized appreciation, NUA, in employer securities. Sounds technical, but you said another significant tax saver, especially for company stock.
It really is, yes. NUA is the growth in value of your employer's stock while it was inside your qualified retirement plan, like a 401k.
Okay.
Here's the tax magic. If you take a lump sum distribution that includes these shares, the NUA, the appreciation part, is generally not taxed as ordinary income right away.
So you don't pay tax on the growth yet?
Not until you actually sell the stock.
Ah.
The original cost basis of the stock is taxed as ordinary income when you receive the distribution. But the NUA part, the growth, gets deferred.
And when you do sell?
When you eventually sell the stock, that deferred NUA is typically taxed at potentially lower long-term capital gains rates, assuming you hold the stock long enough after distribution.
Wow. So turn ordinary income into capital gains later.
That's the potential benefit. It can be a huge tax deferral and rate reduction strategy. For example, if your cost was $10 and it grew to $100K, that $90K NUA avoids immediate ordinary income tax.
Any catches?
The main one is if you roll those shares over into a designated Roth account or Roth IRA. If you do that, the NUA is included in Box 2A and taxed immediately as part of the conversion.
Okay, so NUA is a special opportunity mainly for taking the stock out of the plan in kind. Very interesting, though quite specific. Right, let's tackle box 7, distribution code. This feels like the heart of the story, telling the IRS why the money came out. And you said understanding penalties and exceptions here is critical for saving tax.
Indeed. Box 7 uses these little alphanumeric codes to tell the whole story behind the distribution. It dictates the tax treatment and, crucially, whether penalties apply. Getting this right, or understanding what the code means for you, can save you real money.
Let's get into the weeds then. Which codes should listeners really pay attention to? Maybe start with the one that's generally bad news, Code 1.
Yeah, let's start there. Code 1, early distribution, no known exception. This usually means you're under age 59 and a half, and as far as the payer knows, you don't qualify for an exception.
And the result?
The result is typically that dreaded 10% additional tax on early distributions, on top of your regular income tax. It's a penalty. It highlights why you generally want to leave retirement funds alone until retirement.
Ouch. Okay, but then there's Code 2. Early distribution, exception applies, under 59 and a half. This sounds like the antidote. This is where the tax savings or penalty avoidance happens.
This is absolutely vital. If you see Code 2, it means yes, it was an early distribution, but the payer believes an exception does apply. So generally, no 10% penalty for you. Understanding these exceptions is key.
Okay, what are some common exceptions that trigger Code 2? This feels really important for listeners.
It is. Key exceptions include Roth IRA conversions, you pay income tax, but no penalty. Distributions due to an IRS levy. Certain distributions from governmental 457B plans.
Okay.
A really big one. Separation from service. If you leave your job in or after the year you turn 55, or age 50 for many public safety officers, withdrawals from that employer's qualified plan are usually penalty-free.
Wow, age 55, not 59 and a half. That's a huge difference if you retire early or change jobs.
It is. Also, distributions that are part of a series of substantially equal periodic payments, SEPPs, or 72T payments. If you set up a specific withdrawal plan, you can avoid the penalty early.
Okay.
Certain automatic contribution arrangement withdrawals, and distributions of employer matching funds from Roth SEP or simple IRAs. Code 2 signals relief from that penalty.
That's incredibly useful. Knowing those exceptions could save someone a lot if life happens before 59 and a half. What about Code 3 and Code 4?
Code 3 is for distributions due to disability, permanent, and total disability. These are generally exempt from the 10% penalty. Code 4 is for death benefits, payments made to a beneficiary after the account owner passed away. These are also exempt from the 10% penalty.
So disability or death lifts that early withdrawal penalty burden. That's important relief. What about Code 6?
Code 6 is for a Section 1035 exchange. That's a tax-free swap of certain insurance products, life insurance for life insurance, annuity for annuity, etc. It's non-taxable, allows flexibility. Box 1 might show a value, but Box 2A should be 0.
And Code 7, normal distribution. Sounds like what you want to see eventually.
Yes, Code 7 is the standard normal distribution. Usually means you're 59 and a half or older, or no other code fits. It signifies no early withdrawal penalty applies because you've reached the typical retirement age threshold. It's the goal.
Okay, now let's jump to some really critical ones for tax strategy. Rollovers and Roth codes. Code G and Code H.
Okay, Code G, direct rollover and direct payment. This code is absolutely crucial for tax deferral. It means funds went directly from one plan trustee to another eligible plan trustee, or from an IRA directly to an accepting employer plan. It's non-taxable, keeps your money growing tax deferred.
Always choose direct if you can, right?
Almost always, yes. It avoids potential headaches. Code H is similar, but specifically for a direct rollover of a designated Roth account distribution to a Roth IRA. Again, tax-free, seamless transfer keeps the Roth status intact. Definitely avoid indirect rollovers where they send you the check first unless you really understand the strict 60-day rule. Missing that deadline is costly.
Right, the 60-day trap. Okay, then the code many Roth users dream of. Code Q.
Yes, Code Q. Qualified distribution from a Roth IRA, or Roth Simple IRA. This is the holy grail for Roths. It means the distribution is completely tax-free at the federal level.
What makes it qualified?
Two things must be true. First, you meet an age or life event condition. You're 59 and a half or older, or it's due to death or disability. Second, you've met the 5 tax year holding period for Roth contributions.
The 5-year rule.
Exactly. It starts from the first day of the tax year you first contributed to any Roth IRA or Roth plan. If you meet both conditions, Code Q means 0 federal tax. That's the payoff.
That is the dream. Okay, what about Code Y? You mentioned this is newer and important, especially for charitable giving.
Yes, Code Y, Qualified Charitable Distribution, QCD, claimed by the taxpayer. This is a fantastic strategy if you're 70 and a half or older, have a traditional IRA, and are charitably inclined.
How does it work?
You direct your IRA custodian to send money directly from your IRA to a qualified charity. The huge benefit. That amount is excluded from your gross income.
So it doesn't even count as income.
Correct. And it still counts towards satisfying your required minimum distribution, RMD, for the year, if you have one. It's much better tax-wise than taking the RMD, paying tax on it, and then donating. It directly reduces your adjusted gross income.
Wow. Satisfy your RMD and get a tax exclusion for being charitable. Powerful combo. Any other codes we should flag for pitfalls or planning?
Maybe codes L and M related to plan loans. Code L is for loans treated as deemed distributions. If you default on a 401k loan, it can become taxable and may be penalized.
Ouch.
Code M is a qualified plan loan offset. This is different. It's when your balance is reduced to repay a loan, often when you leave the company. It is a distribution, usually taxable, but not treated the same as a defaulted deemed distribution under Code L.
Good distinction.
Yeah.
And codes N and R recharacterizations.
Yes, N and R relate to recharacterized IRA contributions. N is for current year. R is for prior year contributions being recharacterized now. This is that do-over mechanism. You can change a traditional contribution to Roth or vice versa after the fact to fix a mistake or optimize your tax strategy. Really valuable flexibility.
This box 7 is definitely the narrative section.
Yeah.
So complex. And sometimes you see multiple codes.
You do. A single distribution might need 2 codes to tell the full story, like maybe Code 4, death, and Code G, direct rollover. For an inherited IRA rollover by a spouse, the form usually allows up to 2 codes. If more are needed, especially numeric ones, they might issue multiple 1099-Rs.
So you have to look at the combination.
Exactly. Review all codes to get the complete picture. While there are other codes for specific situations, like code C for certain death benefits or K for hard-to-value assets, the ones we've hit 1, 2, 3, 4, 7, G, H, Q, Y, L, M, N, R, cover the most common and impactful scenarios for most people's tax planning.
Okay, super helpful. Let's quickly wrap up the rest of 1099-R, Box 8, Other. What's typically in there?
Not too common, but it might show the value of an annuity contract you received as part of a larger distribution. That value itself isn't taxed yet. The future payments from the annuity will be. Or it could show those charges for qualified long-term care insurance, generally not taxable.
Box 9A, your percentage of total distribution.
That's just if a total payout went to multiple people, like beneficiaries, it shows your share. Not common for standard IRA withdrawals.
Box 9B, total employee contributions.
This might show your total after-tax contributions, your basis, specifically for certain life annuities from qualified plans or 403(b)s, useful for calculating the tax-free portion of those future payments.
Box 10, amount allocable to IRR within 5 years. IRR.
In-plan Roth rollover. This relates to conversions done inside a 401k plan. Box 10 flags an amount that could be hit with a 10% penalty if withdrawn non-qualifiedly within 5 years of that internal conversion. Helps track Roth conversion rules.
And Box 11, first year of DESIG. Roth contrib. Seems important for Roth rules.
Critically important. This tells you when your 5 tax year holding period started for that specific designated Roth account, like a Roth 401k. You need to meet this 5-year rule plus an age or event trigger for distributions of earnings to be qualified and tax-free.
Tracks that crucial waiting period.
Precisely.
Okay. Then Box 12 for foreign account reporting, FCCF. Box 13, date of payment for certain death benefits. And Boxes 14 through 19 are state and local tax info.
Correct. State tax withheld, distribution amount subject to state tax, local tax withheld, etc. Very important for filing your state return accurately.
Wow. Okay, that's a really thorough walkthrough of Form 1099-R. It really drives home how many different ways money leaves retirement accounts and the tax nuances involved. Let's pivot now. All right, let's switch gears to Form 5498, IRA contribution information. If 1099-R is about money out, what's the main job of Form 5498? What story does it tell?
Form 5498 is the essential counterpart, yeah. It tracks what went into your IRAs and reports the account's value at year-end. So contributions, rollovers in, conversions in, and the fair market value, FMV, as of December 31st.
So 1099-R is outflow, 5498 is inflow and current value.
Exactly. It helps you verify your contributions were received and recorded correctly. It tracks the growth or value, which is crucial for things like calculating RMDs later on. Think of it as your IRA's annual report card.
Got it. Top section has payer and participant info similar to 99R. Let's jump into the boxes. Box 1, IRA contributions, but with a long list of exclusions. What goes here?
Box 1 is primarily for your regular contributions to a traditional IRA for the tax year shown on the form.
Okay.
And importantly, this includes contributions you made for that tax year, even if you actually made them in the following year up until the tax deadline, usually April 15th.
So my contribution for 2025 made in March 2026 shows up on the 2025 Form 5498, Box 1.
Correct. It also includes catch-up contributions if you're age 50 or older. That extra amount you can put in, like the difference between $7,000 and $8,000 for 2025 limits, for example, it's a key way to boost savings near retirement.
Good clarification on the timing. Okay, Box 2, rollover contributions. This must mirror the rollovers reported as distributions on the 1099-R, but showing them arriving.
Precisely. Box 2 reports amounts rolled into any type of IRA during the year. This is a cornerstone tax saving strategy because these rollovers are generally non-taxable. They let you continue the tax deferral.
Examples.
Direct rollovers from 401ks, 403(b)s, 457(b)s into an IRA. It also covers some special rollovers like certain military death benefits rolled into a Roth IRA. It confirms the money landed safely in the IRA without triggering taxes.
Box 3, Roth IRA conversion amount. This reflects that strategic move we talked about earlier.
Yes. Box 3 shows amounts you converted from a traditional IRA or sometimes other pre-tax accounts to a Roth IRA. While this amount is generally taxable income in the year you do the conversion, reported on Form 1099-R, Box 3 confirms the money successfully arrived in the Roth IRA. It's the record of that strategic decision to pay taxes now for tax-free growth and withdrawals later.
So 1099-R shows it leaving the traditional, potentially taxable. 5498 shows it arriving in the Roth.
Exactly. They work together.
Okay. Box 4, Recharacterize contributions. This is that do-over mechanism again.
It is. Box 4 reports contributions you recharacterized change from one type of IRA to another. Say you put money in a Roth but then realized you weren't eligible, so you recharacterized it to a traditional.
How does the reporting work?
The first IRA, the one you took money out of, reports it as a distribution on 1099-R, often with an N or R. The second IRA, the one the money went into, reports it here in Box 4 of Form 5498 as a recharacterized contribution received. It confirms the correction was made. Valuable flexibility.
Definitely useful to fix mistakes. Box 5, FMV of account, fair market value. Why is this number important for you, the account holder?
Box 5 shows the value of your IRA as of December 31st. It's important for a few reasons. One, it just gives you a snapshot of your savings value. Two, the trustees have to value all assets annually, even hard-to-value stuff like real estate or private stock held in an IRA.
Oh, interesting. Even non-public assets.
Yes. And this valuation is absolutely critical for calculating required minimum distributions, RMDs, correctly later on. The RMD is based on the prior year-end value. It's also important for beneficiaries of inherited IRAs.
Okay. Box 6 is for life insurance costs within certain contracts. Box 7 has check boxes for the type of IRA, SEP, Simple, Roth. Boxes 8 and 9 show employer contributions to SEP and Simple IRAs. Then Box 10, Roth IRA contribution.
Right. Box 10 is for your direct contributions to a Roth IRA specifically, not conversions. That's Box 3, not rollovers. Box 2, not SEP or Simple Roth contributions. Boxes 89, just your regular Roth IRA contributions.
All right.
It also includes a newer thing. Qualified rollovers from a 529 college savings plan into a Roth IRA under very specific rules, like the 529 being open 15 plus years, offers a way to repurpose leftover education funds.
Interesting option. Okay, now a really crucial one for avoiding penalties. Box 11, check if RMD for 2026. Sounds like a big red flag.
It absolutely is. Think of it as a flashing light from your IRA custodian. If this box is checked, it's telling you unequivocally that you are required to take an RMD for the next tax year. Your 2026 RMD, if this is the 2025 Form 5498.
Who gets this checked?
Typically, it applies starting in the year you turn age 73 or if you're already older.
And the consequence of ignoring it.
A significant penalty. Failing to take your full RMD subjects you to an excise tax. It used to be 50%, now it's generally 25% of the amount you should have taken but didn't. It can potentially be reduced to 10% if you correct it quickly.
25%? That's steep.
It's incredibly steep. It's throwing money away. This box is a critical reminder from your custodian to help you avoid that penalty. Pay attention to it.
Absolutely. Don't ignore the checkbox in Box 11. And boxes 12A and 12B might even give the RMD date and amount as a courtesy.
They might, yeah. Payers aren't required to report the date and amount to the IRS, but they are required to either provide it to you or tell you it's available upon request, and they must check Box 11 if an RMD is due. Many just put the info in 12A, 12B to be helpful.
Good service if they do. Okay, Box 13A, 13B, 13C.
Yeah.
Postpone late contributions and year code. Sounds like flexibility for special situations.
Exactly. This covers contributions made for a prior year, but after the normal deadline due to specific circumstances. Like if you were serving in a combat zone or affected by a federally declared disaster, you might get extra time.
Yeah.
These boxes also report late rollover contributions. Normally you have 60 days, but the IRS allows late rollovers under certain conditions. Maybe you self-certify you couldn't meet the deadline for reasons beyond your control, or it relates to things like planned loan offsets affected by disasters. It's a tax-saving relief valve to let you get the money back into tax-deferred status.
This is a valuable second chance mechanism. Good to know those exist. And boxes 14A and 14B, repayments and code. This allows putting money back tax-free.
Yes, this reports repayments of certain specific distributions you might have taken earlier, things like qualified reservist distributions, qualified disaster distributions, distributions for birth or adoption expenses, emergency expenses, terminal illness, or for domestic abuse victims.
And if you repay them.
If you repay these amounts within the allowed time frame, usually 3 years for many of them, the original distribution is essentially treated as if it never happened for tax purposes. You don't pay tax on it. Box 14 confirms you put the money back, preserving the tax advantage status.
So you can access funds for specific emergencies and put them back later without penalty or tax.
Under those specific rules, yes, it provides crucial access without permanent tax consequences if repaid.
And finally, boxes 15A and 15B, FMV of certain specified assets and code. What's this about?
This is for reporting the fair market value of those hard-to-value assets we mentioned earlier, non-traded stock, real estate, private equity, LLC interests held in your IRA. The IRS wants these valued, and this box, along with specific codes identifying the asset type, helps track that. Important for accurate RMDs on these less common assets.
Okay, wow. We have thoroughly dissected Form 1099 DAR and Form 5498 box by box. We've gone deep into the weeds. Now, let's pull back up and connect the dots. How do these two forms work together, and what are the absolute key, actionable, tax-saving takeaways for you listening?
They really are two sides of the same coin, giving you that complete picture. 1099 DEF, what came out, and was it taxable, tax-free, penalized? 5498. What went in? Contributions, rollovers, conversions, and what's the account worth now?
Outflow and inflow value.
Right. Together, they give you the annual story of your retirement accounts. Understanding this story lets you manage your taxes proactively, not just reactively. It lets you plan.
Okay, so let's hammer home those key strategies. What's the number one tax-saving takeaway?
Maximize direct rollovers. Seriously, if you're moving retirement money, always try for a direct trustee-to-trustee transfer, indicated by code G or H on the 1099-.
Why so critical?
It completely avoids the risk of missing the 60-day deadline for an indirect rollover. If you get the check yourself and deposit it late, the whole amount can become taxable, plus potential penalties. A direct rollover is seamless, safe, and keeps your money tax-deferred without interruption. Easiest way to avoid a costly mistake.
Solid advice. Avoid the 60-day clock if possible. What's next? Roth strategies.
Absolutely. Leverage Roth accounts strategically. This requires understanding both forms. Qualified Roth distributions, code QAnon 1099-R, are tax-free. That's huge in retirement.
The big payoff.
Yeah. And Roth conversions, box 3 on 5498, codes 2 or 7 usually on 1099-R, are a powerful long-term play. Pay tax now, potentially at a lower rate for tax-free withdrawals later. But you have to track that Roth 5-year rule. Box 11 on 1099-R is key here to make sure your withdrawals are truly qualified.
So Roths require understanding the rules but offer big tax benefits. What else is crucial?
Understand and track your basis. We keep coming back to this. Box 5 on the 1099-R. If you've ever made after-tax contributions to a traditional IRA or have bases in a Roth 401k, keep meticulous records. This is your money coming back tax-free. Don't let the IRS tax it again. It directly reduces your taxable distribution. Overlooking basis is just leaving money on the table.
Don't pay tax twice. Got it. And for those with company stock?
Yes. Consider NUA, net unrealized appreciation. Box 6 on 1099-R. If you get employer stock in a lump sum, NUA allows you to defer tax on the growth and potentially pay lower capital gains rates later when you sell. It's a specialized but potentially very valuable strategy. Don't just automatically roll it over without considering NUA.
Worth investigating if that applies. Okay, what about avoiding penalties?
Take your R&Ds. That box 11 checkmark on Form 5498 is your warning. Ignoring required minimum distributions leads to that nasty 25% excise tax. Use the forms as your annual reminder. Plan ahead, take the distribution, avoid the penalty. It's completely avoidable.
A penalty you choose to pay by inaction. Not smart. What about charitable giving?
Explore QCDs, qualified charitable distributions. If you're 70 and a half or older, code Y on the 1099-R signals this. Direct transfer from your IRA to charity, excluded from your income, and satisfies your RMD. A brilliant tax-efficient way to give. Talk to your advisor about this if you're charitable.
Great strategy for the right person.
Yeah.
What if you're under 59 and a half and need money?
Know the exceptions to penalties. Check box 7 on the 1099-R carefully. Don't just assume you owe the 10% penalty. Codes 2, exception applies. 3, disability, or 4, death are your friends here. Many life events trigger exceptions: separation from service after 55, disability, SEPPs. Understanding these can save you that 10% hit.
Don't assume the worst. Check the codes and rules. And finally, what about fixing things?
Correcting mistakes is possible. The system has flexibility built in. Recharacterizations, codes NR on 1999-R, box 4 on 5498, let you change IRA contribution types. Late rollover relief, box 13 on 5398, can save you if disaster strikes. Repayments of certain distributions, box 14 on 5498, let you put money back tax-free. Don't assume a mistake is permanent. Explore if there's a fix. Hashtag tag out.
Well, we have certainly gone deep today. We've navigated the twists and turns of Form 1099-R and Form 5498. Hopefully we've turned these from, intimidating documents into tools you can actually use.
Yeah, the goal is clarity and control. When these forms show up, you shouldn't feel confused or anxious. You should feel empowered because you understand what they mean, what the opportunities are, what the pitfalls to avoid are.
It's about being proactive with your taxes and your retirement planning.
Exactly. Knowing your financial story, as told by these forms, and how to manage it optimally.
Absolutely. Remember that knowledge isn't just power, it's real financial leverage. Understanding these forms empowers you to do more than just file your taxes correctly. It helps you truly optimize your financial future, make smarter choices.
Couldn't agree more.
So the question for you listening is, with this deeper understanding, what tax saving opportunity revealed in these forms will you explore next year?